Something happened in the silver market that looks simple on the surface but becomes deeply unsettling the longer you stare at it and try to understand the timing, the reactions, and the people who benefited from the chaos. Just days after silver suffered one of the worst crashes in nearly half a century, the United States government quietly scheduled an emergency meeting focused on critical minerals, and that timing alone should immediately raise questions that most investors are not asking. Silver did not just dip or pull back, it collapsed violently, losing 41% of its value in less than 3 days, falling from $121 to $72 in a move not seen in 46 years. Markets across the world reacted with panic. Screens turned red, commentators rushed to explain the damage, and many investors were left staring at their losses, wondering how everything unraveled so fast. What makes the situation different is not just how hard silver fell, but what was happening elsewhere at the exact same moment, completely outside the focus of Western headlines. While traders in the United States and Europe were rushing to sell, trying to protect what little profit they had left, buyers in another part of the world were calmly stepping in and doing something that seems almost impossible to believe. They were buying the same silver at a price nearly 30% higher, without panic, without fear, and without hesitation, while the Western market was in full meltdown mode. At a time when silver was trading near $78 in Western exchanges, the Shanghai market was pricing silver above $101 per ounce, creating a gap that should not exist in a normal market. This was not a small difference caused by shipping or fees. It was a massive disconnect that signaled something far deeper than simple volatility or emotional trading. The same metal, pulled from the same earth, refined in the same way, was being treated as cheap trash in one market and as valuable supply in another market at the same moment. That alone forces one uncomfortable question to the surface, which is why anyone would pay more for something they could supposedly buy cheaper elsewhere. The answer to that question is not simple, but it begins with understanding that not all prices reflect reality, especially when paper contracts and physical demand begin to move in opposite directions. Welcome to Alex Carter Reports, where we focus on the financial moves happening quietly behind the scenes rather than the loud headlines designed to grab attention after the damage is already done. This channel exists because the most important shifts in money, power, and resources usually happen far away from television studios and social media feeds. Before we can understand the crash itself, we need to step back and look at what led up to it, because silver did not fall from the sky without warning. In early 2025, silver was trading near $30 per ounce, quietly ignored by most investors and barely mentioned outside niche markets. Over the next 13 months, silver exploded higher, climbing relentlessly until it reached $121 by late January of 2026. That rise represented a 300% gain in just over a year, a move so extreme that it naturally attracted attention from speculators chasing fast profits. Gold followed a similar path, reaching an all-time high of $5,595, driven by the same powerful forces reshaping global finance. Central banks were buying aggressively, countries were reducing reliance on the US dollar, and industrial demand for precious metals continued to rise year after year. For most of that rally, the move higher made sense, supported by long-term trends that did not disappear overnight. But toward the end, the character of the market changed, and that change mattered more than the price itself. Short-term traders flooded in, momentum funds chased the move, retail investors jumped aboard, and automated systems began amplifying every price swing. In January alone, silver surged 54%, a pace that no healthy market can sustain for long without consequences. Night after night, heavy buying from China pushed prices higher while American traders slept, creating a sense that silver only moved in one direction. Every morning, Western traders woke up to missed gains of 3 to 5%, fueling fear of missing out and encouraging even more reckless buying. One strategist later described January as the most unstable and emotional month in precious metals trading history. At that point, silver was no longer responding to supply and demand fundamentals, but instead to adrenaline, leverage, and speed. Markets driven by adrenaline always end the same way, because emotion eventually burns itself out. On Thursday, January 30th, the spark finally arrived that triggered the collapse. President Donald Trump announced Kevin Warsh as his nominee for the next Federal Reserve chair, signaling a shift toward tighter monetary policy. Warsh is known for supporting higher interest rates and less support for inflation hedges, which historically puts pressure on precious metals. At the same time, the US dollar began to strengthen, creating a double blow for metals priced in dollars. That combination was enough to puncture the speculative bubble that had formed at the top. Gold dropped $200 in just 10 minutes, a move so fast that most traders could not react in time. Silver, however, did not just fall, it collapsed under the weight of forced selling. The selling began in Asia, led by the same traders who had fueled the rally weeks earlier. Once prices started falling, margin calls triggered automatic selling across exchanges, accelerating the decline. Each forced sale pushed prices lower, triggering more margin calls, creating a cascade that fed on itself. Veteran traders later said the speed of the collapse felt unreal, as if humans were no longer involved at all. Algorithms sold to algorithms, while human decision-making became irrelevant. By the time European markets opened, the damage was already severe. On Friday, January 30th, silver plunged 37% in a single day, marking the worst one-day crash since 1980. Traders across the world used the same word to describe what they were seeing, and that word was bloodbath. But what most people still do not realize is that Friday was not the final bottom. Over the weekend, the CME Group raised margin requirements on silver futures from 11% to 15%. This change forced traders to post more cash immediately or liquidate their positions. Thousands could not meet the new requirements and were forced to sell into an already falling market. By Monday, silver touched $72, completing a 41% collapse in less than 72 hours. Gold fell to around $4,400, marking its worst decline in more than a decade. Every major asset class was bleeding at the same time, leaving investors with nowhere to hide. This is where most coverage ends, with warnings and explanations that focus only on what went wrong. But this story does not end with the crash, because the most important part was happening somewhere else entirely. While Western markets were drowning in panic and fear, something completely different was happening quietly inside China. And almost nobody in the West noticed it until after the damage was done. As silver prices collapsed on US and European exchanges, I pulled up the Shanghai data, expecting to see the same chaos, the same fear, and the same rush to sell. What I saw instead made my stomach drop, because it told a story that did not match the headlines flooding financial media. At the exact same moment silver was trading near $78 in Western markets, the Shanghai Gold Exchange was pricing silver at $101.86 per ounce. That is not a typo, not a glitch, and not a delayed quote, but a real verified spot price reflecting what buyers in China were actually paying. This created a price gap of nearly $23 per ounce between East and West, a difference so extreme it should not exist in a properly functioning global market. That gap represented a premium of just over 29%, meaning buyers in Shanghai were willingly paying almost a third more for the same metal everyone else was dumping. This was not happening after the crash, or days later, but during the crash itself, while fear dominated Western trading screens. The same silver, pulled from the same mines, refined to the same purity, was being valued in two completely different ways depending on where you were standing. That reality alone should force anyone paying attention to pause and question whether the lower price truly reflected value or simply reflected panic. Markets are supposed to be efficient, but efficiency breaks down when paper contracts overwhelm physical demand. In Western markets, silver is often traded as a financial instrument, a promise on a screen, rather than a physical object that must actually be delivered. In Shanghai, pricing reflects physical demand first, meaning real buyers who need real metal set the tone. When those two systems disconnect, price no longer tells the full story. The fact that Shanghai was paying a massive premium during a crash suggests the cheaper Western price may not have been real in any meaningful sense. It suggests the paper market was collapsing under leverage, while the physical market remained tight and highly contested. To understand just how serious this disconnect has become, it is not enough to look at one day of pricing. I went back and studied the Shanghai premium trend over the last 12 months, not focusing on silver's price itself, but on the gap between East and West. What that chart revealed was shocking, even to someone who has followed commodity markets for years. Over the past year, the Shanghai silver premium increased by 1,874%. That number is not normal, not healthy, not something that happens by accident. Markets do not produce four-digit percentage changes unless something fundamental is breaking beneath the surface. A growing premium means physical buyers are increasingly willing to pay more to secure supply, regardless of paper prices elsewhere. It means trust in paper pricing is eroding, while demand for real metal is intensifying. This was the first sign that the crash may not have meant what most people thought it meant. But the story does not stop there, because the futures market in China revealed something even more revealing. As prices fell, every single silver contract on the Shanghai Futures Exchange hit its limit down threshold. Contracts across the curve, including AG26, EG2603, and EG2604, were all locked at minus 20%. Trading was frozen, not slowed, but completely halted as circuit breakers kicked in. Traders could not sell even if they wanted to, because the system itself stopped the fall. Now here is the part that completely changes perspective. When you convert those limit down prices into US dollars, the February Shanghai contract at its absolute worst price was still $94.97. At the same time, Western futures were freely trading below $79. China's worst-case scenario price was still $16 higher than where Western markets were operating without restriction. In other words, China's floor was higher than the West's ongoing trading price. That is not passive observation, but active intervention. Chinese regulators stepped in aggressively to stabilize the market before panic could spiral out of control. 5 major commodity funds were fully suspended from trading, not limited, but shut down entirely. The UBS SDIC Silver Futures Fund was suspended for the second time in just 12 days. 16 traders were barred from opening new positions or withdrawing funds for an entire month. Position limits were cut, margin rules were tightened, and authorities threw everything they had at cooling speculation. This was not an attempt to crush silver, but an effort to prevent uncontrolled buying and selling from destabilizing supply. And after all of that intervention, silver still rebounded from $72 to $85. That rebound matters more than most people realize. It shows that despite the chaos, real buyers stepped in once prices reached levels they considered unreasonable. The floor held, not because of hope, but because demand was real. This raises an important question that should keep investors awake at night. If Chinese exchanges began tightening rules on January 27th, days before the crash, it means they saw the danger coming. They were preparing for volatility while Western markets were still chasing momentum. If China saw this coming, who else did? And that question leads directly into the next phase of this story because it involves one of the most powerful financial institutions in the world quietly making a move that speaks louder than any headline. While most investors were still trying to understand what had just happened to silver prices, one of the largest financial institutions in the world made a quiet decision that revealed far more than any public statement ever could. J.P. Morgan, the biggest bank in the United States and one of the most powerful players in global precious metals trading, recently moved its gold trading desk to Singapore. This was not an expansion, not a satellite office, and not a temporary experiment, but a full relocation of people, systems, and decision-making power. They did not move that operation to New York, London, or any other traditional financial center that has dominated metals trading for decades. They moved it directly into the heart of Asia, where physical demand is growing fastest and where real metal is actually changing hands. This type of move does not happen on a guess or a rumor because relocating a trading desk across the world costs millions of dollars and takes years of planning. Banks only make decisions like this when their smartest people have already reached a long-term conclusion. That conclusion appears to be that the center of gravity for precious metals is no longer in the West. Singapore sits at the crossroads of Asian physical demand, central bank accumulation, and rapidly growing commodity infrastructure. It is close to China, close to Southeast Asia, and positioned where real metal flows instead of just paper promises. J.P. Morgan did not move because of one bad trading week or one volatile month. They moved because the data has been pointing in this direction for a long time. Asian central banks have been buying gold for 14 consecutive months, steadily building reserves without fanfare. China has been securing physical resources methodically, not reacting to price swings, but focusing on long-term supply. COMEX disruptions, delivery concerns, and rising premiums have been warning signs that the old system is under stress. Singapore has also been positioning itself as a global hub for physical gold trading and tokenized commodity assets. All of this created an environment where staying anchored in the West made less and less strategic sense. J.P. Morgan chose to be where the future demand is growing, not where financial tradition says it should be. This move is similar to watching a billionaire quietly sell luxury city property and buy farmland without explaining why. You do not ignore a decision like that because wealth does not move randomly at that scale. You ask what they see that others are missing. When you combine this relocation with the Shanghai silver premium, the story becomes clearer and more unsettling. On one side of the world, paper markets are dominated by leverage, margin calls, and automated selling. On the other side, physical markets are focused on supply, security, and long-term access to critical resources. Those two worlds used to move together, but they are now drifting apart. This divergence became impossible to ignore after the silver crash exposed just how fragile the paper system has become. The fact that Shanghai continued paying a massive premium while Western markets collapsed tells us the physical market never lost confidence. It simply waited for forced sellers to finish dumping. This is not how dying assets behave. Now connect that to what happened next, because the timing becomes even more disturbing. Just days after the crash, the United States announced it would host an emergency meeting focused on critical minerals. The meeting was scheduled for Wednesday, February 4th, 2026. Secretary of State Marco Rubio is hosting the inaugural Critical Minerals Ministerial at the Department of State in Washington, D.C. International delegations from around the world are flying in to attend. The official explanation is that they are meeting to strengthen and diversify critical mineral supply chains. When governments use language like that, it usually means something is already broken. Strengthen and diversify is code for dependence, vulnerability, and urgency. It means supply chains exist that cannot be trusted in a crisis. It means resources essential to national security may not be available when needed. Silver plays a far bigger role in this discussion than most people realize. Silver is not just a metal for jewelry or coins sitting in a drawer. It is a core input for modern technology and military infrastructure. Solar panels require silver to function, and without it, production stops entirely. Electric vehicles use silver in electrical contacts throughout the vehicle. Fifth-generation communication towers rely on silver components to transmit data. Semiconductors depend on silver for conductivity and performance. Advanced military systems, including guided weapons and satellite communications, require silver to operate. Medical imaging equipment also uses silver, making it essential for healthcare systems. Every smartphone contains silver, meaning demand is embedded into daily life. In 2025 alone, the world consumed 680 million ounces of silver for industrial use. That represents 60% of total silver demand being used up permanently, not stored or recycled easily. The silver does not sit in vaults. It disappears into products and infrastructure. At the same time, global silver production has been running at a deficit for years. The world has been using more silver than it mines annually. The gap has been filled by drawing down existing stockpiles, which are steadily shrinking. New supply cannot be turned on quickly because most silver is mined as a byproduct of copper and zinc. There are very few primary silver mines on Earth. Opening a new mine takes close to a decade, even if prices surge immediately. This creates a structural trap where higher demand cannot be met with fast supply. That reality is what makes silver different from most commodities. Now imagine sitting in a government meeting room with this information in front of you. A metal critical to technology, energy, and defense is running in a multi-year supply deficit. Physical buyers are paying massive premiums. Paper markets just collapsed violently under leverage. And one of the largest banks in the world just moved its metals operations to Asia. This is not a coincidence, it is a signal. In the next phase, we are going to connect all these dots together and walk through the timeline that makes this entire situation feel anything but random. When you line up the events of the last few weeks in the correct order, something unsettling begins to emerge, because the timing of these moves does not feel random no matter how many times you replay it. Individually, each event can be explained away, but together they form a pattern that suggests preparation rather than surprise. Let's walk through this timeline slowly, because each step builds on the last in a way that completely reframes the silver crash. In late January, silver was trading at $121 per ounce, and gold was sitting at $5,595. Both at historic highs. Market sentiment was euphoric, confidence was extreme, and many traders believed the rally would continue without interruption. Then on Friday, January 30th, silver collapsed by 37% in a single day, while gold dropped roughly 9%. Panic spread instantly across global markets, with investors scrambling to exit positions as fast as possible. That weekend, the CME Group raised margin requirements on silver futures, forcing even more traders to liquidate positions they could no longer afford to hold. By Monday, February 3rd, silver hit $72, completing a 41% collapse in less than 72 hours. At the same time, gold fell to around $4,400, marking its worst drop in more than a decade. While Western markets were in full panic mode, Chinese exchanges were doing something very different. Every silver contract on the Shanghai Futures Exchange hit its limit down threshold, and trading was frozen to stop uncontrolled selling. 5 commodity funds were suspended, 16 traders were barred from trading, and position limits were cut aggressively. Even at those limit down levels, Shanghai silver prices were still far higher than Western prices. The Shanghai spot price showed silver trading above $101, while Western markets hovered below $80. That created a premium of over 29% during the height of the crash. This was happening while headlines in the West were declaring silver finished and broken. On Tuesday and Wednesday, something unexpected occurred. Silver rebounded from $72 to around $85. Gold climbed back above $4,800. Buyers returned quickly and prices stabilized instead of continuing to fall. That alone should have raised eyebrows, because assets that are truly broken do not bounce that hard and hold. Then comes the part of the timeline that ties everything together. On Wednesday, February 4th, 2026, the United States hosts an emergency critical minerals meeting in Washington, D.C. Secretary of State Marco Rubio welcomes international delegations for the inaugural Critical Minerals Ministerial. The stated goal is to strengthen and diversify critical mineral supply chains. In government language, that signals concern, urgency, and vulnerability. Governments do not convene emergency meetings over commodities they believe are abundant and secure. They do so when supply risk becomes a national security issue. Silver sits at the center of that risk, even if it is rarely mentioned by name. The world consumed 680 million ounces of silver for industrial use in 2025. That demand is not optional, because it powers energy systems, communications, and defense infrastructure. More than half of all silver demand disappears into products that cannot easily be recycled. At the same time, the world continues to mine less silver than it uses each year. Existing stockpiles have been filling the gap, but those stockpiles are shrinking. This means the system is living on borrowed time. Now add another layer to this timeline. JP Morgan recently moved its precious metals trading desk to Singapore. That move places them closer to physical demand, central bank buyers, and rising Asian premiums. They did not announce it loudly or promote it publicly. They simply repositioned quietly, while everyone else focused on price charts. That decision occurred in the same window as the silver crash and the government meeting. These events are not isolated when viewed together. They tell a story of shifting power from paper markets to physical markets. They suggest that institutions and governments are preparing for a future where access to real metal matters more than futures prices. Now ask yourself a simple question. If silver were truly collapsing in value, why would governments be discussing supply chains at the same time prices fell? If demand were dying, why would Shanghai continue paying massive premiums? If precious metals were no longer strategic, why would JP Morgan move its operations closer to Asia? The answers point in one direction. This was not the end of silver, but a stress test. The crash exposed leverage, speculation, and weak hands. It flushed out excess without breaking the underlying structure. The physical market held firm while the paper market unraveled. That distinction matters more than any headline. This is why Alex Carter Reports focuses on context rather than noise. Crashes do not destroy value. They transfer it from those who react emotionally to those who prepare patiently. Someone was buying while others were selling in fear. Someone was securing supply while others were closing positions. The timeline tells us exactly when and how that transfer took place. After the chaos settled and the panic selling finally slowed, something happened that most people completely misunderstood, because they were too focused on the damage instead of the response. Silver did not continue falling into nothingness, and gold did not spiral endlessly lower the way truly broken assets often do. Instead, silver rebounded from $72 to around $85 in a very short period of time, while gold climbed back above $4,800. That kind of recovery does not happen by accident, and it does not happen without real buyers stepping in with conviction. When markets truly collapse, prices do not snap back quickly and hold their ground. They grind lower slowly for months or even years as confidence disappears and demand fades away. That is not what happened here. The speed and strength of the rebound sent a quiet but powerful signal that demand had not vanished. It simply waited for forced sellers to finish dumping positions. This tells us that the crash was driven by leverage and panic rather than a collapse in real-world need. Real buyers were not chasing prices higher during the mania. They were waiting patiently for the moment when prices disconnected from reality. When silver hit $72, those buyers stepped in. They were not speculators looking for quick flips. They were buyers who needed silver to keep factories running, supply chains moving, and long-term plans intact. Industrial demand for silver does not disappear because of a red candle on a chart. Solar manufacturers cannot pause production because futures traders panic. Silver paste is essential for solar panels, and without it, production lines shut down completely. That silver component represents only a small portion of the final product cost. Even if silver prices double, it barely changes the price of the finished panel. But without silver, there is no panel, no product, and no revenue. That makes industrial silver demand highly inelastic. It does not care about margin calls or emotional selling. It buys silver because it must. This same logic applies to electric vehicles, data centers, medical equipment, and defense systems. These industries cannot simply stop consuming silver because markets are volatile. This reality created a natural floor under prices. That floor was not visible on charts until after the panic passed, but it was always there, waiting quietly. Another important factor supporting the rebound is how companies are now sourcing silver. Instead of relying solely on exchanges, some manufacturers are reportedly securing supply directly from mines. These private agreements bypass futures markets entirely. When buyers do this, it signals a lack of trust in exchange delivery systems. They are not looking for the best paper price. They are looking for certainty of supply. This shift matters more than daily price swings. It means physical availability is becoming more important than paper valuation. That change weakens the influence of speculative selling over time. It also explains why Shanghai prices remained elevated during the crash. Physical buyers were not fooled by paper panic. They recognized the disconnect and acted accordingly. At Alex Carter Reports, we always look at both sides, and it is important to acknowledge real risks as well. This rally did include speculative excess. Prices did move too far too fast. A correction was not only possible, but necessary. Some analysts, including former JP Morgan strategist Marko Kolanovic, have warned that silver could still fall toward $50 if speculation continues to unwind. A stronger dollar could pressure metals further. A slowdown in global growth could reduce industrial demand temporarily. These are real scenarios and should not be ignored. Anyone claiming silver can only move higher from here is not being honest. Markets move in cycles, not straight lines. This is not financial advice, and no one should invest money they cannot afford to lose. But it is equally dangerous to ignore what the recovery is telling us. Silver's rebound was not weak or hesitant. It was fast and decisive. Gold showed the same behavior. That pattern suggests buyers with deep pockets were waiting for those levels. Well, they did not chase the top. They waited for stress to reveal weak hands. Then they stepped in. This is how long-term capital operates. It lets speculation burn itself out. Then it moves quietly. The crash did not destroy silver's role in the global economy. It exposed how fragile the paper system has become. It separated financial noise from physical reality. And that separation may be the most important development of all. Crashes are often described as moments of destruction. But in reality, they are moments of exposure, revealing things that were hidden when prices were rising and optimism felt effortless. What happened in the silver market was not just a sudden collapse in price, but a rare moment where the difference between paper value and physical reality became impossible to ignore. Wealth does not disappear during crashes. It moves, shifting from those who react emotionally to those who have prepared patiently. While screens in the West were glowing red and fear dominated every decision, strategic buyers were quietly stepping in, securing supply at levels they believed were unsustainable. At the exact moment silver was trading near $72 in Western markets, buyers in Shanghai were still paying over $100 for physical metal. That was not retail behavior, and it was not speculation. That was long-term capital acting with intention. This is the part of the story that most investors never see, because it does not show up on a trading app or a breaking news banner. The crash did not reveal that silver was worthless. It revealed that two different silver markets now exist. One market trades paper contracts, driven by leverage, algorithms, and margin rules. The other market trades real metal needed for factories, infrastructure, and national security. Those two markets used to move together closely enough that the difference barely mattered. That relationship has now fractured. What we witnessed was not a temporary glitch, but a separation. The Western paper market collapsed by 41%. The physical market barely flinched. Shanghai premiums surged instead of disappearing. Government intervention focused on controlling speculation, not stopping demand. Funds were suspended to cool excessive buying, not to prevent selling. This distinction is critical. It tells us where confidence truly resides. It also explains why J.P. Morgan moved its precious metals operations to Singapore. You do not relocate an entire trading desk across the world unless your data is telling you something fundamental has changed. That move places them closer to physical demand, central bank buyers, and real supply flows. It signals where they believe the future of precious metals pricing will be decided. Now connect that to the emergency meeting in Washington. On Wednesday, February 4th, 2026, the United States hosts a critical minerals ministerial with international partners. Governments do not call emergency meetings over commodities they believe are abundant and secure. They do so when supply risks threaten economic stability and national defense. Silver sits quietly at the center of that concern. It is consumed, not stored. It is essential, not optional. It cannot be replaced easily, and it cannot be mined quickly in response to higher prices. 680 million ounces were consumed for industrial use in 2025 alone. That demand continues regardless of market volatility. The world has been running a silver supply deficit for years. Stockpiles are shrinking. New mines take a decade to open. This creates a long-term imbalance that short-term crashes do not fix. This is why the recovery after the crash mattered so much. Silver did not drift lower aimlessly. It bounced sharply and held. Gold did the same. That behavior signals accumulation, not abandonment. It tells us real buyers were waiting. They did not chase prices during the mania. They waited for forced selling to create opportunity. This is how structural trends survive volatility. The parallels to the 1970s are impossible to ignore. Gold surged, crashed hard, was declared dead, and then went on to rise 400% from the lows. The crash did not end the trend. It removed the tourists. Silver's crash may serve the same function. It shook out leverage. It punished speculation. It scared away weak hands. But it did not change the underlying need for the metal. If anything, it highlighted how critical silver has become. So when people ask whether silver is finished, they may be asking the wrong question. The real question is which silver they are talking about. Paper silver may be broken. That system just proved how fragile it is. Physical silver, however, has never been more important. Governments are discussing it behind closed doors. Banks are repositioning to be closer to it. Factories cannot operate without it. And buyers are paying premiums to secure it. This is why Alex Carter Reports exists, not to tell you what to buy or sell, but to provide context when noise dominates reason. The biggest disadvantage for everyday investors is not lack of money or access. It is lack of perspective. The most important signals were not on your screen during the crash. They were in Shanghai premiums. They were in regulatory actions. They were in government meetings. They were in quiet relocations of capital and infrastructure. Those signals tell us where value is moving, not where it has already been. I could be wrong. Markets are complex and outcomes are never guaranteed. But after staring at this data from every angle, the conclusion remains the same. The crash was real, the pain was real, but what it exposed may matter far more than the losses themselves. The paper and physical silver markets have gone their separate ways, and what happens next will depend on which one ultimately sets the price. That is the question that will define this story going forward. Drop your thoughts in the comments and share this with someone who needs to see the bigger picture. If this helped connect dots you had not seen before, make sure you are subscribed to Alex Carter Reports. This is not the end of the story. It may only be the beginning.